The global financial markets are currently witnessing a rare and complex phenomenon, a simultaneous surge in the US dollar index, DXY, treasury yields, and gold, all occurring against a backdrop of risk-on sentiment fueled by a dovish tilt from Federal Reserve officials. While textbook economics often suggests these assets should move in opposite directions, today's price action reveals a deeper narrative of capital flow and economic divergence. 1. The dovish dollar, a flight to yield, not fear. Typically, when the Fed signals interest rate cuts, a dovish stance, yields drop and the dollar weakens. However, the current strength in the DXY and US 10Y yields suggests that the market is prioritizing US economic exceptionalism. Even with a dovish Fed, if US growth data remains superior to that of Europe or Asia, capital will continue to flow into the United States. This represents a positive capital flow. Investors are not buying dollars out of fear, but rather to access the highest risk-adjusted returns in the developed world. The rise in yields is a reflection of a soft landing being priced in, where growth remains resilient despite the easing cycle. 2. Gold's defiance. Gold rising alongside a strong dollar and higher yields is a classic signal of inflationary hedging. If the market perceives the Fed as being too dovish, cutting rates while the economy is still running hot, investors turn to gold to protect against currency debasement and long-term inflationary pressures. 3. Case study, AUD CHF, the ultimate strong versus weak play. In this high volatility environment, the most effective trading strategy is often the simplest, pairing the strongest fundamental currency against the weakest. The AUD CHF long position currently stands as the alpha play for several reasons. The commodity engine, AUD. The Australian dollar is riding a wave of strength in the industrial metals sector. With iron ore and copper prices surging, the AUD acts as a direct proxy for global industrial growth. The funding source, CHF. As a classic safe haven, the Swiss franc is the first asset to be sold when risk-on sentiment dominates. In a market where investors are hungry for growth, the CHF becomes a primary funding currency, creating a natural downward pressure on the pair. The divergence. By going long AUD CHF, a trader is essentially betting on the continuation of global growth while shorting market fear. I executed a high-probability trade, buying the strongest currency of the day, Aussie, and selling the weakest, CHF, which falls on risk-on days, and the Swiss bank revealed this week that it will fight against the currency's appreciation, adopting a dovish stance. Take profit. 4. Outlook and risk management. While the momentum favors the risk-on trade, the primary risk remains a yield spike. If US yields rise too aggressively, they may move from attracting capital to restricting growth, which could trigger a sudden deleveraging event. However, as long as commodity prices hold their ground and the Fed maintains its dovish bias, the AUD CHF remains one of the most logically sound expressions of the current macro landscape. Subscribe in my channel to learn fundamental forex analysis